The Financial Sense Midweek Edition with Jim Paplava, delving in-depth with authors and experts into the key economic issues.
Felix Zulauf of Zulauf Asset Management joins me on the program. You know, Felix, on the day you and I are talking, everywhere I look, the headlines I read each day don't look good to me. Nearly all of the global markets look to be rolling over, and we have the global LEIs are falling. We've got government austerity programs that are being implemented at the wrong time, in my opinion. Felix, am I being too gloomy in my assessment?
No, I think you are very realistic in your assessment. Unfortunately, I have to say, the Western world or the industrialized world, we have moved ourselves into a very messy situation. And what we see right now is the cyclical factors are turning negative on top of structural factors that are very fragile. And this combination is not very pleasant. And you see the markets have been sleeping at the wheel. They didn't understand the fundamentals up to just recently when the U.S. released its GDP figure for last quarter. And that was sort of a wake-up call to the investment community. And I think they are beginning to adjust their expectations for the future course of the economy. And that's what you see, of course, together with a lot of structural issues on the debt situation, debt ceiling in the U.S. And the euro situation over here in Europe. It's an ugly picture, unfortunately.
You know, perhaps we can move on to the macro backdrop, starting with the developed world first, and I'd like to begin in your backyard, which is Europe. My Bloomberg screens are showing widening credit spreads within Europe with Greece, Portugal, and Ireland. And now, Felix, I'm starting to see yields rise more recently in Italy and Spain, which looks somewhat alarming.
Yes. Greece has about as much debt as the U.S., or the other way around. The U.S. has as much debt as the U.S., but the U.S. has an ability to print its own dollars and to provide liquidity when the government is in trouble, financial trouble. Greece hasn't that option left because they are part of a monetary union. And that is part of why the whole problem accentuated. Of course, going back, the big problem of the industrialized world is having too much debt outstanding relative to the size of the economy. And the problem always surfaces first where the weakest links are. And the weakest link was Iceland a few years ago, and then Greece, and then Ireland, and then Portugal, and now it has moved to Italy and Spain. And we have a real funding crisis in Europe. Some people call it a debt crisis, which it is a debt crisis. Some people call it a banking crisis, and it is a banking crisis. Some people call it a currency crisis, and it is a currency crisis because all these factors are highly interlinked. We have deposits, bank deposits, declining at the rate of over 10% in Greece and in Ireland, and the ECB, the European Central Bank, is funding those banking systems that they can continue to function. Otherwise, they would collapse. Obviously, it has now happened in Italy that for the last 2 months, deposits have begun to shrinken, and we are now in negative territory. And I expected that. I mentioned that even by a media Barron's interview and pointed to that upcoming problem. And a funding problem is very serious because the biggest buyer of Italian bonds, government bonds, has been the banking industry. The banking system bought 60 to 90% of all the government debt that has been marketed or launched in the last few years. And now that biggest buyer is having funding problems. And that means that he cannot buy as much as he used to. And he probably, or some members of the banking community, will probably be forced to sell. And that's driving interest rates higher. And that creates many questions that are opening up, because now we are coming to the key question: can the euro system as it stands and the project continue, or will it break up? Because Greece is a small fish. Greece is such a small economy. Germany and France and some others can easily take over liabilities and guarantee that it's a small fish. But Italy is the third largest government bond market in the world after Japan and the US, and its outstanding government debt are 3 times as big as Greece, Portugal, and Ireland together. And this cannot be financed easily. And now Germany has to answer that key question: are we going to guarantee the Italian debt or not? And if they say yes, they are then in a fiscal union. If they are in a fiscal union with other European member states, it means that they have to guarantee the liabilities of those governments. And I would put that number at way north of 500 billion, probably closer to 1 trillion euros. And if Germany had to take that step, you would have a heck of a political debate in Germany. You would have the Constitutional High Court going to decide whether that is against the Constitution, etc., etc. So all hell could break loose in the next couple of weeks or months, depending on how the German government answers that question.
And this brings me to the question about Europe, where you have a monetary union without a fiscal union. And the whole process seems to be misfiring. So in many ways, as you just pointed out, how can this function when in reality you have imbalances between the core countries, such as Germany and France, and the periphery? It looks like, to borrow an analogy, a house built on an unstable foundation.
That's quite right. It could only function if the structure and competitiveness of the different economies was very, very similar to each other. But it's not the case. Productivity is much higher in Germany than it is in Italy or in Greece. Unit labor costs are 30% higher at the periphery, in the peripheral countries, compared to Germany. So when you have that discrepancy, what happens with a monetary union without the fiscal union is that the weaker, the less competitive economies are continuing to run chronic external deficits, and it builds up a tower of debt vis-a-vis the center. And if Germany would say, okay, that's fine with me, we can live with that because at the end it won't be worth anything, that's fine. But the world doesn't function that way. And that's why we have to come up to this decision. Usually when you go through the history of monetary unions, all of the monetary unions that were not at the same time fiscal unions and political unions broke up. It was only a matter of time. The shortest one was about 15 years, the longest one was about 100 years, but they all broke up. And the current situation in Europe is such that the competitiveness is so much apart between Germany, the center, and the periphery that the stress in the system has grown to a point here where a final decision has to come up. And it could be that the final decision is coming up this year, in the second half of this year. So Chancellor Merkel should not be on vacation because she has to make a big decision.
You know, everybody has been aware of the problem with the pig countries, Portugal, Italy, Ireland, and Greece. And for the most part, the markets have been focusing on Greece. As you pointed out, it is a much, much smaller economy given the size of Europe's economy. But recently, Italy and Spain have come on the radar, which is another storm front that's brewing. And I think, Felix, very few people have noted this other than people like yourself. And I think one reason is we don't think of Italy as having gone through the boom and bust credit cycle like so many states in Europe and here in the U.S. So, and the other thing, too, as you look at Italy, the consumer sector isn't as heavily indebted, for example, like it is in the United States. So is it mainly a banking crisis where you had banks which are buying Italian debt and a confidence in the banking system is causing withdrawals, in essence, a bank run? Is this the heart of the issue?
It is part of the issue. You are absolutely right that unlike most of the other peripheral European countries that had a credit boom and housing boom and a bust, Italy didn't have that. Italy didn't have the credit boom and didn't have a real estate boom and didn't have a bust. They had a situation where productivity gains have not come through for a long period of time, and it was the government that went heavily into debt and enjoyed the low interest rates given by them via the monetary union because they all of a sudden enjoyed German low interest rates. So in Italy, it is the government problem. And what you have in Europe, as was the case actually in the U.S. in 2008, is you have a very fragile banking industry. You know, the financial architecture of our system is extremely fragile and thin because the financial institutions have simply not enough equity capital. On average, the European banks, the big banks, the large banks that are important to the system, they have about 3% of equity capital. Now, when anything goes wrong and markets turn down and their asset prices go down, they are in trouble. And what you see going on right now is that their asset side is freezing because of that. And when their asset side is freezing, some people realize it and they withdraw deposits. And you have now a slow-motion bank run in Italy as people are withdrawing money from the Italian banking system, which makes the funding of the government large debt that has to be issued to finance the budget, the government's household, so to speak, virtually impossible or only possible at ever higher interest rates. And that's what you see in the market. Interest rates are driven up. And as interest rates are driven up, you have the normal reactions to it. First of all, the better placed governments tell the not so well placed government what they have to do. You have to go into austerity. You have to cut spending. You have to raise taxes, which of course will then weaken the economy and which will lead to less tax revenues, etc., and which will lead to larger deficits at the end and larger borrowing requirements. It's a deflationary spiral the system gets into. And that's where we are. We are in the early stages of such a deflationary spiral. And it can only be stopped by central banks intervening and stepping in, or by the system breaking apart and some of the countries go back to their own former national currency. Now, what will happen? I don't know. But I think the chances are pretty high that some countries have to go back to their own individual currencies, because then they have to devalue their currencies by 30, 40, 50% or so, and they become competitive again. Of course, at first, that banking system would be bust. The central bank had to refinance the whole system, of course, but after a year, the recovery would begin. They would be competitive again. The Germans could go to Italy and have cheap vacation, spend the money, and the Italians would have jobs and be busy and make money, all in devalued liras. But nonetheless, the system would function. And the markets are forcing a decision, and they will not let go. it continues. The ECB could step in. In the case of the U.S., the Fed would have stepped in a long time ago. But the ECB is different. First of all, the ECB doesn't want to end up with an enlarged balance sheet that is full of junk bonds of the peripheral countries. And that's why they have gone just recently through a battle with the national governments, and they want that the governments guarantee those bonds. And that's why the ECB has not stepped in, and the ECB want the governments to step in and want the fiscal union, because they know very well that the monetary union only continues to function properly if there is a fiscal union. Now, the question is, are the Germans, and at the end it will be the Germans, are the Germans prepared to take over that liability of 1 trillion euros? That's the key question. In the meantime, the bank run in Italy continues. Italian bond yields continue to go up. Spanish bond yields continue to go up, and markets are forcing the issue. And at the same time, stock markets go down because interest rates go up. When interest rates go up and the system is tightening, it's not the central banks that are tightening. It is the credit system itself that is tightening because it is so thinly capitalized in terms of equity capital. And that's the difficult and ugly situation we are in. And of course, the unpleasant things always arrive at the wrong time, namely at the time when the leading indicators for the future course of the economy around the world has turned down and pointing lower. So solving those problems we have on the table, you cannot do in a slowing world economy or even economies that go into recession. You can only do that when you have good growth, and that is not on the horizon.
This brings me up to, it seems, a problem or a conundrum for many of these countries, because many of them have embarked on austerity programs. But however, as you just pointed out, Felix, when austerity is implemented in a weakening or slowing economy, it actually makes matters worse. So it's a lot like, I don't know, stepping on the chest of someone who's having a heart attack. So now we have a private sector that is overtaxed and overregulated, and on the public side, you have austerity being imposed in the public sector. So this raises the question, what growth engine is left?
Well, that's true. I'm not sure the private sector is overtaxed. Actually, I think when you look at tax rates in the U.S., historically speaking, they are at the lower end of the range, and I firmly believe that tax rates eventually will rise. There is no way around it. In Europe, it's a little bit different. Italy is one of the highest taxed countries, but that's because you have a lot of mafia business, black market business that, is escaping being taxed and things like that. And I think they will eventually tighten those things. So there are things that could be done. But it's true, it's pretty ugly. We have here a cocktail for a deflationary decline of the industrialized economies, and I do not see how we can get easily break out of this. When you look at it very carefully, the U.S. has just arrived with a debt ceiling deal which introduces some fiscal austerity. And quite surely, finally the world has discovered, or the government, the decision makers have discovered that we got the problem. We have too much debt and we need to cut our spending down to normal levels. But again, this wakening up is coming at the wrong time. It's coming when the economies are turning down. I figure that what is planned for fiscal policy for next year or the next few years will cut between 0.5% to 2% out of GDP in the U.S. The same is true for the U.K. At least as much is true for the European peripheral. Now, when you tighten fiscal policy so much, that's difficult because monetary policy does not work in an over-leveraged, over-indebted economy, because too many economic subjects cannot or will not take up new credit, and therefore, even at lowest levels of interest rates, you cannot get credit growing. And in credit-based economies, you cannot get an economy growing without credit growth. So it's a very difficult situation. We are starting austerity and fiscal tightening right at the point when the economies are weakening, which means that we probably have a recession on the table for next year on a worldwide basis. The emerging economies are a little bit different. They are also slowing down. They are also tightening, but much less than the industrialized economies. And their growth rates and their structural situation is much better than the industrialized world. I still believe that the industrialized world is more important to the general goings in the world economy than the emerging economies because they set the pace. So it's a very ugly situation, unfortunately, and it doesn't mean any good for investors who invest in equities or even commodities. And it means a lot of good for those for a short while, who invest in perceived safe haven assets like gold, and for a limited period of time, maybe even treasuries.
You know, it appears to me from what we've been discussing here is we have a series of dominoes that seem to be toppling one another. And you had mentioned earlier with the European financial stability, there's, I think, close to €500 million in euros. However, this package, as you pointed out, Felix, is probably not large enough to handle all the collateral damage, especially if Italy gets into trouble. So you mentioned that the only one big enough to bail out the problem countries is Germany. However, this, I suspect, would have to be put to a vote to the German voters. And as you raised the question, will they go for it, or will they feel like we do in the U.S. where taxpayers were asked to bail out, let's say, irresponsible banks? You have Angela Merkel, who's a politician. All politicians want to keep their job. But like many politicians, she kicks the can, or she could kick the can down the road until, let's say, she's backed into a corner with a crisis. And if she dithers or fiddles while Europe burns, in essence, doesn't that create another crisis?
Well, that's where we are. We are right there. Think, Angela Merkel, you have to understand, the German chancellor, she was raised as a child of a clergyman who fled from Western Germany to Eastern Germany to the communists because he thought those are the better people. So she was raised in that family environment, and she was trained with the communists. She was a communist leader. She was trained on ideology in Moscow, and it's a shame that the biggest European economy has a chancellor who was a former communist. I think it's a pity. And my German friends, behind closed doors, they agree with me, but nobody would speak up, of course. So that means that she really doesn't understand free markets very well. I mean, she trained perhaps a little bit on the job, but she doesn't understand it very well. And the only compass she has no ideology really anymore. The only compass and target she has is to get reelected. And getting reelected when big decisions are coming up, she tried to kick the can down the road. But I think we are now at the point with Italy, that's the big whale that's coming up to the surface. And there you cannot kick the can down the road anymore. Now, in the next couple of weeks, I think in the second half of this year, the decision will be up whether Germany agrees to a fiscal union or not. So far, we have only had bailouts, and we have that program, the European Financial Stability Facility, EFSF, which is planned to be 440 billion euros. I think so far they only have about 200 or 250 billion there, and it has still to be ratified by the different parliaments. That has not been the case. Therefore, that fund could not handle, from the size, it could not handle Italy, and from the current money available, it could not handle Italy. It can handle Greece, it can handle Portugal, but it cannot go beyond that. And to handle Italy and Spain would mean that the EFSF has to be raised to at least 1.5 trillion, probably even to 2 trillion, which would then make it clear to everybody that the liabilities taken on by the German government and the German taxpayer would be so enormous that even the citizens in the street who do not care much about economics would wake up. And then I think a political debate would unfold, and most likely the Germans would say no to a fiscal union. So if they say no to a fiscal union, then it means the Euro project is finished the way we know it. Then it's finished, and then some member countries cannot fund their economies and their banking systems, and therefore have to find another solution, and that would be the return to the local currency, to the former national currency.
I want to move on to the rest of the world next, in particular the U.S. and China. The leading economic indicators and the PMIs have fallen dramatically in the U.S. In China, their PMI has fallen below 50. And China's growth rate is now around 9%. And some analysts, Felix, believe it's overstated because, like the U.S., they understate their inflation rates. Meanwhile, in the U.S., our first quarter GDP was downgraded to 0.4%, and the second quarter came in on the first pass less than 1.3%. Yet, we still hear from economists, they're still talking about a strong second half in the year for the U.S. It reminds me that they're still working with what I call outdated economic models that function better in economies that were unencumbered by debt. Do you find it surprising, Felix, that we have economists still talking about a strong second half in the U.S.?
I really don't. I don't find it surprising. But let me move on to China first and then go to the U.S. again. You can count me among those analysts who think the numbers are overstated there. Inflation is probably twice as high as indicated, which means that real growth is probably closer to the low one single digit, 2, 3, 4% or something like that. What's interesting is the Chinese seem to be acting just very differently from what the U.S. did when they had a problem with a credit boom and housing boom, etc., etc. They are trying to squeeze the excesses out of the system. And I'm impressed by what they are doing. They have tightened, they have introduced a lot of restrictions to bring home prices down. And in several first-tier cities, home prices are actually declining. And they are now moving on to second-tier and third-tier cities to do the same. They really want to squeeze excesses out of the system. They can do that because most home owners and buyers have a lot more equity in their home than was the case in the U.S. At the time of the boom. And you have to understand that there is a big battle between the government in Beijing and the central bank, because the central bank are much closer to the new government people that will come in next year when there will be the change in government than to the current government. And the government would like to be a little bit less restrictive and more expansive, while the central bank likes to go on and continue with the restrictive policy, and they are trying to squeeze the inflation problem out. And that's why I think it will continue, and economic growth in China will be less than what people assume and expect for the next 12 months. That's China. Now, the U.S. we are human beings, and we are conditioned by what we have experienced in our life. And usually the last 10 years count more than the older period way back. And, today's economists have been trained 20, 30 years ago at high schools, at university, etc., and they have used those models of the old times. Some believe in monetary policy, some believe in other things, but they have used their models that worked very well until a few years ago. I think the old models have broken down and do not work anymore. And I think in our last interview I pointed out that financial markets, who used to be the best leading indicators for the economy in the U.S. and in most industrialized countries, not anymore, because QE, quantitative easing by central banks, is working well on financial assets and commodity assets, tradable assets, etc., but it's not working well to stimulate final demand in the economy, because too many economic subjects are overextended in their debt, have weakened balance sheet, and have to save more and spend less, and therefore cannot and don't want to assume new credit. In this situation we are in, fiscal policy works, because fiscal policy means the government spends money and provides orders, jobs, etc., etc. And we have seen the biggest fiscal stimulus program in 2009 and 10. By the end of 2010, those programs ended. And it's interesting that way before the problem with the nuclear meltdown in Japan happened, that created supply disruptions in the manufacturing chain worldwide, the weakness really started in the economies around the world, not just in the U.S. But financial community didn't take notice because they believed in the forecasting ability of the stock market, and higher stock prices for them meant better economy in the future. So they stayed very optimistic. And once the fiscal stimulus faded and turned negative, which was early this year, and it will stay well into 2012 negative, it means that those expectations will be sharply undershot by reality. And the deviation from expectations eventually will be so large that the investment community will turn negative because they have to cut their earnings estimates for the corporate sector. And I think we are in the early stage of recognition that something was wrong with the forecast. There are still many economists who forecast some re-acceleration in the second half. I wouldn't bet on it. I think it's plain wrong. The best I could see is maybe 1.5% growth, and it could be worse than that, and next year it could even be a recession. And that's why the stock market is acting actually very realistically by selling off. So it doesn't surprise me, and it doesn't surprise me that some economists are still using the old models and forecasting better growth, but I think they are plain wrong.
Felix, if you were an economic advisor, and let's say you got a call from either President Obama or Chancellor Angela Merkel, what advice or what course of action would you advise?
Well, for Chancellor Merkel, I would tell her very clearly, stop the Euro project. Try to combine the center of the European economies for a currency snake like we had in the old times. You could even have a reduced Euro project for the center, including the Netherlands, maybe France, but France will become a problem later on, I think. I think a lot of those numbers are flawed. So I think you have to cut the periphery off, because the pain that those economies and citizens of those economies will suffer will be so horrendous that they will eventually revolt. So that would be my advice to Chancellor Merkel. To President Obama, I would tell him that the economy needs support, but it needs the right support. And you should change your whole government spending program decisively and cut entitlements to the bare necessity and go into major infrastructure investment programs to provide jobs, work, income to the people. And if you can do that, you cannot create an environment that is painless, but you can create an environment that will be much less painless than what we are going into right now.
In contrast to your own views, with the actions that policymakers are actually taking now, in your opinion, Felix, what will be the end result?
Well, we have now an economy that goes down based on the introduced austerity and fiscal policy, and the economy declining and weakening and financial markets weakening. We will get to a point where the authorities will respond to it. And then it will be important to see what they do. The easiest way for them to respond is print money. Now, QE3 will be very difficult to do because QE2 was counterproductive. It created higher inflation and it cut real income for the average citizen short, and that was really one of the reasons the economy also slowed down. So they will do it nevertheless. Even it's wrong, it doesn't work, they will do it nevertheless. If it's not accompanied by a structural change in fiscal policy, we go just through another short-term quick fix, and it may look okay for a few quarters until it doesn't anymore. And then we are back to where we are now, but even worse structurally. So I would think in the marketplace, markets are now going to sell off up to a point where the authorities respond. I do not know where that point is. I was looking for a temporary low, sometimes in fall, around 1100 S&P or so. That was my original expectation, about 20% down from the top, and in peripheral European markets more than that. But eventually, I think they will only react with a short-term quick fix, a small version of what I just described, and that will give you only a pop for a few months maybe, and then we go down further into 2012 at probably a lower low, and then we will have the real business cycle response with a fiscal program, etc., etc. And everything decided on fiscal austerity will be thrown overboard because of the crisis we are in at that time. And then we have maybe another year or two where markets could rise again. It's ugly. It doesn't get us out of this structural situation. What it will eventually do is it will push assets like gold to much higher highs because people's mistrust in governments, central banks, and the value of money of our major currencies will continue to decline. And a rising gold price is just a reflection of that.
It seems like central bankers have sort of boxed themselves into a corner by overusing these monetary tools, such as quantitative easing. But you almost get a sense, I believe, Felix, they would prefer to reliquefy the system, but as you pointed out, if they do so now, it might ignite an inflationary fears in the market. If they wait too long, they may be facing their worst fear of a deflationary recession, or worse, maybe a depression could take hold. It almost appears that we need some kind of crisis to unfold before they act, or, as you just mentioned, before the government acts with, let's say, a fiscal stimulus, which is out of the question now given the recent debt ceiling debate. But once again, if authorities wait too long, could it be it would be too late? In other words, it almost appears like this is an impossible juggling act And can they realistically pull it off?
Well, that's a difficult question to answer, Jim. I really do not know. The risks are getting higher and higher each cycle because the extremes and the thinness of and fragility of our financial architecture is getting more and more dangerous. And I must tell you, policymakers have never dealt with an environment like we are in right now. Policymakers in the U.S. have taken it for granted that the U.S. economy will always grow at 2.5% or 3% trend growth. It can swing around that trend growth, but they assume that as a given. And they have no formula and no receipt, so to say, how to function and what to do when the trend growth is 1% or 1.5%, because in an over-leveraged situation with so low growth, you put the system at the edge. We are at the brink, and it could happen that we have a deflationary accident. At some point of time, central banks will come in, but to really support the system, consider that the total debt in the U.S. economy is about 55 or 60 trillion U.S. dollars. To really support that system, it would mean that the central bank's balance sheet had to increase from the current almost 3 trillion to maybe $30 trillion to support it. If you did that, if we did see that, you can imagine what would happen to the U.S. dollar. It would break down to pieces. And it's also clear that if you had such moves in the markets, that markets would not be free again. There would be all sorts of capital controls. There would be all sorts of dirigist measures, government-controlled economies, so to speak. So it's a very dangerous situation we are in. And unfortunately, I do not have a formula how to solve it. And what is sure is there is no formula that is painless how to fix it. If you want to fix it, we have to be able and ready to take a lot of pain. I do believe in human beings in the long run. We are just going through one of those crises that happens to arrive once every second generation or so, and the outcome is unclear. And when the outcome is unclear and you are in such a situation, the most important thing for investors is try to preserve capital. Don't be too adventurous. Stick to investments you understand and know. Don't go for big capital gains, but for safety. That's the advice I would give.
Felix, I got in the business in 1979. At that time, inflation was running around 14%. Bond yields, I can remember, were over 15%. Gold and silver were heading towards $850 an ounce. And the U.S. looked at the time that it was on the ropes. Yet, at the height of that dismal economic environment, we seem to have reinvented ourselves and underwent several decades of prosperity. So I guess, is it possible we could do it again? I guess what I'm saying is it possible that things aren't as dire as they appear today? Could the clock maybe possibly reset itself again? In essence, is there room for optimism as you gaze into the future?
Well, Jim, I would like to answer that question, that important question, with yes, but I can't, because the prosperity that we have enjoyed since the late 70s and early 80s was built on accumulating unseen amounts of debt. It was a fiction. It was a fiction, and unfortunately, we consumed that debt already. It's not that we have invested it and invented great things and put machinery and plants in place that yield constant returns. Some we did. We have telecommunication revolution. etc. We have some bioscience revolution. But in general, we spend most on consumption or malinvestment, and the tower of debt is still there. So I do not believe that we can repeat those 20, 30 years by going again into the same amount of debt. That's not possible. And that's why it's so difficult. We have to, one way or another, to reduce total outstanding debt relative to the size of the economy. And either we default on a lot of the debt, or we inflate the debt away to lower levels relative to the size of the GDP. And I think for the next couple of years, the deflationary pressure will remain very high, and the responses by the authorities will be inflationary policies. And after a number of years, I think we go into higher inflation. Not because of a boom, of an economic boom, but because of economic misery. Very high inflation and runaway inflation and declining currencies always arrive when you go into misery and not out of an economic boom. So I'm unfortunately not having a good outcome for this situation. I think it will be very messy, very painful. We will all get wet. As I said recently to a friend, there will be a big storm. We have entered that big storm. There will be lightning. There will be mudslides. There will be overfloodings. We will all get wet. But don't try to be at the point where the lightning comes in, where the flooding is, and where the mudslides are. You just stay away from those risks, and then you do better than most others.
I want to touch upon the one investment area that you briefly mentioned, and that's the subject of gold, which is currently at a record as we are speaking. And it seems to me that it's resuming its historical role as money. What surprises me is that gold, which has gone up now for 11 consecutive years, it's up nearly sevenfold, and yet it remains underowned. Very few money managers own it outside of like the big hedge fund managers like a Paulson. Gold equities, Felix, are even rarer to find in an investment portfolio. And even now, with every new milestone that gold surpasses, we hear the voices in the financial media telling us why gold is in a bubble. What's your view on gold?
Well, I look at gold the other way around. I look at currencies in terms of gold. And whenever we have an economic situation that requests or requires negative real interest rates for a number of years, you usually have a decline in the paper value of currencies relative to the price of gold. We had that first big waterfall decline of paper currencies in the 1970s during rising inflation and negative real interest rates due to too low interest rates and rising inflation all the time. That was started by Paul Walker, and then for a number of years we had positive high real interest rates. That's when gold corrected for 10, 15 years or even longer. And until we entered the problematic situation again about 10 years ago. And since then, we have basically a period, and we have been in, and we will continue to be in a period of negative real interest rates in all major currencies. And that means that these currencies are now in the second waterfall decline against gold. That will continue until real interest rates go positive to at least 1%. We are far from that, and I don't foresee anything like it in the next few years. So I think it will be years out until we will see that. And therefore, the waterfall decline of paper currencies continues. Looked at it the other way, it means that the rise of gold will continue, because the rise of gold is expressing the mistrust in governments, in central banks, and in currencies. And gold is an alternative to paper currency. It has no liabilities, and it cannot be mismanaged, etc., etc. And that's why I think it will continue. Can gold correct $100 or $200? Sure, anytime. It's gone up like a straight line. It can easily correct $100 or $200. If it does, buy more, because the rise is not over for a long time, and we will probably be surprised how high it will go, which doesn't speak well about paper currencies, of course.
That brings me to, let's say, my final question, because we all know at some point an asset class reaches a peak. I, like you, don't know what that final price will be for gold, and I suppose that depends on what governments do in the interim. But when that asset or that level is reached and we get to the level where we begin to rectify things, when the gold bull market ends, Felix, in your opinion, what new asset class will replace it, or specifically, where do you believe the new opportunities will lie in the future?
Well, that's probably a few years down the road, but I would say what replaces gold then could be new currencies that are stable and backed by maybe a basket of commodities, including gold, and things like that. I do not believe that we will have an end of this current bull market in gold without a few currencies disappearing. I think some of the currencies will disappear and will go through a currency reform, which obviously means that a lot of people, owners of fixed income investments, will lose a lot of money at that time. I do believe that in the long run, once we have established a new system, cleaned out the old system from too much debt, etc., I do believe in human nature, in the innovation, in the drive to go forward and progress, etc. And then I would definitely go back to equities, because equities are a piece of entrepreneurial ownership. And in a functioning economy that grows nicely and is cleansed by excesses, you want to be an entrepreneur or an investor, invest with entrepreneurs that are successful. So you have to go back to equities at that point of time.
Well, Felix, I want to thank you for joining us on the Financial Sense News Hour. Always interesting to speak with you and get your perspectives. Sometimes those of us that live here in the United States have maybe only one source or way of looking at things, and it's always nice to get somebody that lives across the pond and sees the world sometimes differently than we do. I want to thank you for joining us on the Financial Sense News Hour. Felix, if our listeners would like to follow you, how could they do so? I know that you are a member of the Barron's Roundtable, and you, of course, get a chance to express your views there twice a year.
Well, that's one way. You can look at my homepage, www.zuam.ch. There are occasional reports posted on it, or interviews, some in German, some in English, both languages. And I do not accept any fresh money anymore, but I advise some clients, and one of them is a global macro hedge fund in the U.S. It's a younger hedge fund. It's only 12 months old. The manager thinks very similar to me, and he's younger, he's very capable. He uses similar tools, and he has done an outstanding job in the last 12 months, being up about 15% net. And I'm in constant contact with him. I'm a big investor in his fund. I have some insight because I see the portfolio every week, and we are in constant contact. So there you can get access to some of my money management capabilities. But the manager is my partner over there in Pasadena, California, actually, Rick Campagna of 300 North Capital. That's how you can stay in contact with me.
Well, Felix, once again, I want to wish you good evening, and thank you so much for joining us once again on the Financial Sense News Hour. It has been a pleasure speaking with you.
Thank you very much, Jim. It's been my pleasure. Thank you for having me, and all the best.
You can subscribe to Financial Sense NewsHour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/financialsenseonline. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense NewsHour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the NewsHour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising